You need to see this chart, because what just happened in the silver market, it's only occurred twice in modern history, and both times, fortunes were made by those who understood what was coming next. Let me show you exactly what I'm talking about. Silver just broke above $50 per ounce. Now, if you're not a precious metals person, that might not sound significant, but here's what makes this absolutely extraordinary. The last time silver traded at these levels was over 4 decades ago. We're talking about a price point that an entire generation of investors has never witnessed. But it's not just about the price level. It's about what's happening beneath the surface. Because the mechanics driving this move are fundamentally different from anything we've seen in recent memory. And understanding these mechanics could be the difference between watching from the sidelines and positioning yourself for what could be the trade of the decade. Let me take you back to 1980 for a moment. Silver hit its previous peak at $49.45 per ounce in January of that year. But that wasn't a natural market move. That was the Hunt brothers trying to corner the entire silver market. They were buying physical silver, taking delivery, and attempting to squeeze the shorts. It was manipulation on a massive scale. And when it collapsed, it took silver down for decades. Fast forward to 2011. Silver made another run, briefly touching $48. But that was a different animal entirely. That was the aftermath of the 2008 financial crisis. Central banks were printing money like it was going out of style. Quantitative easing was the new normal, and investors were piling into precious metals as a hedge against currency debasement. When that fear subsided, silver crashed from $48 to $26 in a matter of weeks. But what's happening right now? This is neither manipulation nor panic buying. This is something far more structural and far more sustainable. Let me show you the supply side first, because this is where the story gets really interesting. Silver mine production has been declining. Not just flat, actually declining. We're producing less silver today than we were several years ago. And here's the kicker. There's no quick fix for this problem. You can't just flip a switch and open a new silver mine. It takes years of exploration, permitting, development. We're talking 7 to 10 years from discovery to production in most cases. And the mining companies? They haven't been investing in new capacity. Why? Because for years, silver prices were too low to justify the capital expenditure. So we've got this situation where supply is constrained. But that's only half the equation, because on the demand side, something extraordinary is happening. And this is where it gets really fascinating. Industrial demand for silver is exploding. And I'm not talking about traditional uses like jewelry or silverware. I'm talking about the technologies that are reshaping our entire economy. Solar panels, electric vehicles, 5G infrastructure. Every single one of these technologies requires silver, significant amounts of silver. A single solar panel uses about 20 grams of silver. Doesn't sound like much, right? But when you're installing hundreds of millions of solar panels globally every year, those grams add up fast. We're talking about thousands of tons of silver being consumed just by the solar industry alone. Electric vehicles, each one contains roughly twice as much silver as a traditional combustion engine vehicle. And we're not talking about a gradual transition here. We're talking about a wholesale shift in the automotive industry. Major manufacturers are committing to all-electric lineups within the next decade. But here's what most people miss. Silver isn't just being used in these technologies, it's being consumed. When silver goes into a solar panel, it's not coming back. It's not like gold sitting in a vault that can be melted down and reused. That silver is gone from the market permanently. So you've got declining supply meeting surging demand. Economics 101 tells you what happens next. But there's another layer to this story that makes it even more compelling. Central banks are waking up. For decades, central banks focused almost exclusively on gold. Silver was an afterthought. But something shifted. They're starting to recognize that silver isn't just a monetary metal. It's a strategic industrial metal. And in a world where supply chains are being weaponized, where countries are competing for technological supremacy, silver is becoming a national security issue. Look at what China has been doing. They've been quietly accumulating silver for years, not making headlines about it, not announcing their purchases, just steadily building their stockpiles. Why? Because they understand that whoever controls the silver supply controls a critical input for the technologies of the future. And it's not just China. Other nations are starting to pay attention. They're looking at their strategic reserves and realizing they're dangerously exposed. If there's a supply disruption, if geopolitical tensions escalate, if trade routes get cut off, they need to have domestic stockpiles. Now let me show you what's happening in the paper markets, because this is where things get really interesting. The COMEX, the major futures exchange where silver is traded, has been showing some unusual patterns. The amount of physical silver backing those paper contracts has been declining. Meanwhile, the number of contracts being traded has been increasing. What does that mean in plain English? It means there's a growing disconnect between the paper market and the physical market. Traders are buying and selling contracts representing silver that may not actually exist in deliverable form. And historically, when that disconnect gets too large, something breaks. We saw hints of this during the Reddit-driven silver squeeze attempt. Retail investors tried to take physical delivery of silver, and suddenly, premiums exploded. Dealers couldn't source physical metal fast enough. The paper price and the physical price diverged significantly. That was a warning shot, a preview of what could happen if there's a real supply crunch. But here's what makes the current situation different from that Reddit moment. This isn't being driven by retail speculation. This is being driven by fundamental supply and demand. Industrial users are competing with investors for a shrinking pool of available silver, and when industrial users need silver for production, they'll pay whatever it takes to secure supply. Think about a solar panel manufacturer. If they can't get silver, their entire production line shuts down. They're not going to let that happen over a few dollars per ounce. They'll pay up. And when they start paying up, it sets a new floor under the price. Now, I want to talk about something that doesn't get enough attention in these discussions. The gold to silver ratio. Historically, this ratio has averaged around 60-1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. But right now, even with silver's recent surge, that ratio is still elevated compared to historical norms. Why does this matter? Because it suggests that silver still has significant room to run relative to gold. If gold continues its bull market, and the gold to silver ratio reverts to its historical average, the math gets really interesting really fast. We're talking about silver potentially doubling from current levels just to reach historical parity with gold. And here's the thing about silver that makes it different from gold. Silver is more volatile. It's a smaller market. When money flows in, it moves the price more dramatically. Gold might go up 50% in a bull market. Silver could go up 200% or more. We've seen it happen before. In the 2000s bull market, gold went from $250 to $1,900. Silver went from $4 to $48. That's a 12 times move compared to gold's 7.6 times move. I'm not saying that's guaranteed to happen again, but I am saying the potential is there. The setup is there, and the fundamentals are arguably stronger now than they were then. Let me shift gears for a moment and talk about something that's relevant if you're thinking about your long-term financial security. A lot of people don't realize you can actually hold physical precious metals inside a retirement account. It's called a gold IRA, though it can hold silver too. If you've got $100,000 or more in retirement savings, this might be worth looking into. I put together a free guide that explains how it works, how to do it without tax penalties, and what to watch out for. It's in the description if you want to check it out. No pressure, just something to be aware of as an option. All right, back to what's happening in the silver market right now, because there's another angle to this story that's absolutely critical to understand. The energy transition. Governments around the world have committed to net zero emissions targets. They've committed to massive infrastructure spending on renewable energy, and silver is at the heart of that transition. It's not optional, it's not a nice to have. It's essential. The International Energy Agency estimates that silver demand from the solar industry alone could triple over the next decade. Triple. And that's just one sector. When you add in electric vehicles, 5G infrastructure, energy storage systems, the numbers become staggering. But here's the problem. The silver market is tiny compared to the scale of investment flowing into these technologies. The entire annual silver market is worth maybe $30 billion. Compare that to the trillions being invested in the energy transition. It's a rounding error, which means even a small percentage of that capital flowing into silver could move the price dramatically. And we're starting to see that happen. Investment demand for silver has been picking up. ETF holdings are growing. Retail investors are buying physical coins and bars. But we're still in the early innings of this move. Most investors still don't understand the silver story. They're focused on gold, on Bitcoin, on tech stocks. Silver is still flying under the radar for the mainstream. But the smart money is paying attention. Look at what the mining companies are doing. Silver mining stocks have been outperforming, not just a little, significantly, because the market is starting to price in what higher silver prices mean for their profit margins. And if silver continues to climb, those margins are going to explode. Here's something else that's fascinating. The cost of producing silver hasn't changed much. It still costs roughly $15 to $20 per ounce to pull silver out of the ground, depending on the mine. But silver is trading at $50 plus. That's a massive margin. And unlike other commodities where high prices bring on new supply, silver supply is constrained by the factors I mentioned earlier: long lead times, permitting challenges, capital constraints. So miners are printing money at these prices. But they can't increase production quickly, which means those high margins are likely to persist. And that makes silver mining stocks incredibly attractive from a fundamental standpoint. Now, let me address something that skeptics always bring up. They say, but silver crashed after 1980. It crashed after 2011. Why would this time be different? Fair question. And here's the answer. The previous peaks were driven by temporary factors: manipulation in 1980, crisis-driven fear in 2011. But the current move is being driven by structural, long-term trends. The energy transition isn't going away. Industrial demand isn't going away. Supply constraints aren't going away. In fact, the supply situation is likely to get worse before it gets better. Because even if miners wanted to bring on new supply, they can't do it quickly. We're locked into this supply-demand imbalance for years to come. And here's another critical difference. In 1980 and 2011, silver was primarily an investment asset. People bought it as a speculation or a hedge. But today, silver is increasingly an industrial necessity. Companies need it for production. They're not going to stop buying if the price goes up. They're going to secure supply at whatever price necessary. That creates a much more stable demand base. It means silver isn't just dependent on investor sentiment. It's supported by real, tangible industrial consumption that's growing every year. Let me paint you a picture of what could happen if this trend continues. Imagine silver at $75 per ounce. That's only a 50% increase from current levels. Not unreasonable given the fundamentals. At $75, you're looking at solar manufacturers paying significantly more for a key input. But here's the thing. Silver represents maybe 5% of the total cost of a solar panel. So even if silver doubles, it only increases the panel cost by 5%. That's manageable. They'll pay it. But at 75 silver, the mining companies are making incredible margins. Their stock prices could easily double or triple from current levels. And investors who positioned early in physical silver or mining stocks could see substantial returns. Now imagine silver at $100. That's a psychological barrier. But there's no fundamental reason it couldn't get there. At $100, you're looking at a market that's finally pricing in the true supply-demand dynamics. And at that level, silver would still be undervalued relative to gold on a historical basis. But here's what most people don't think about: the reflexive nature of these moves. As silver goes up, it attracts more attention. More investors pile in. That pushes the price higher, which attracts even more attention. It becomes self-reinforcing. We saw this in the 2000s bull market. We saw it in 2011, and we could see it again. The difference is, this time there's a fundamental foundation supporting the move. It's not just speculation, it's real supply-demand dynamics, which means the move could be more sustained, less prone to a sudden crash. Now, I want to talk about timing for a moment, because one of the questions I get asked most often is it too late to get into silver? And my answer is always the same. It depends on your time horizon. If you're looking to make a quick trade, trying to time the exact bottom and top, then yeah, maybe you've missed some of the move. Silver has already rallied significantly. But if you're looking at this as a multi-year trend, if you're thinking about where silver could be in 3 to 5 years, then we're still early. Think about it this way. The energy transition is a decade-long process, maybe longer. Industrial demand is going to keep growing. Supply is going to remain constrained. Those fundamentals don't change based on short-term price movements. They're structural trends that will play out over years. And here's something else to consider. Most investors still don't own any silver. It's not in their portfolios. They're not thinking about it, which means there's a massive pool of potential demand that hasn't entered the market yet. When that demand shows up, when silver becomes a mainstream investment thesis, that's when things could really accelerate. We're seeing early signs of that mainstream adoption. Financial media is starting to cover silver more frequently. Analysts are putting out bullish research reports. Retail investors are asking their financial advisors about precious metals exposure. These are all leading indicators of broader participation. But we're not at the euphoria stage yet. We're not at the point where everyone and their grandmother is talking about silver at dinner parties. That's when you know a market is topping. We're nowhere near that level of sentiment yet. Let me share something that I find particularly compelling: the geopolitical angle. We're living in an increasingly multipolar world. The dollar's dominance is being questioned. Countries are looking for alternatives. They're diversifying their reserves. They're building strategic stockpiles of critical materials. Silver fits perfectly into that narrative. It's a monetary metal with thousands of years of history. But it's also a strategic industrial metal that's essential for modern technology. That dual nature makes it incredibly valuable in the current geopolitical environment. And here's what's interesting. Unlike gold, which is primarily held by central banks and wealthy individuals, silver is more accessible, it's more affordable, which means it could play a role in a broader monetary reset if that's where we're headed. I'm not predicting that, but I am saying it's a possibility that's worth considering. Think about what happened when Nixon closed the gold window back in 1971. Gold went from $35 to $850 over the next decade. Silver went from $1.50 to $50. That was a monetary regime change, and precious metals were the beneficiaries. Could we be on the cusp of another regime change? The debt levels, the money printing, the geopolitical tensions, there are certainly parallels. Now, I want to address risk for a moment. Because nothing goes up in a straight line. Silver is volatile. It can have sharp pullbacks. If you're going to invest in silver, you need to be prepared for that volatility. You need to have a long-term perspective. You need to be able to stomach 20% or 30% drawdowns without panicking. But here's the thing about volatility. It cuts both ways. Yes, silver can drop sharply, but it can also rally sharply. That volatility is actually what creates the opportunity for outsized returns. If you want stable, predictable returns, buy bonds. If you want the potential for significant gains, you need to accept some volatility. And in the current environment, with the fundamentals as strong as they are, I'd argue that the risk-reward is skewed to the upside. The downside is probably limited by industrial demand and production costs. But the upside? The upside is potentially substantial if the supply-demand dynamics continue to tighten. Let me give you another way to think about this. What's the opportunity cost of not being in silver? If silver does what the fundamentals suggest it could do, if it rallies to $100 or beyond over the next few years, what does it cost you to sit on the sidelines? That's a question worth asking yourself. Because here's the reality. Most people wait until an asset has already made a massive move before they get interested. They wait for confirmation. They wait for everyone else to validate their thesis. And by the time they finally buy in, they've missed most of the gains. The time to position yourself is when the fundamentals are strong but the mainstream hasn't caught on yet. And that's exactly where we are with silver right now. The fundamentals are screaming. The supply-demand dynamics are tightening, but most investors still aren't paying attention. There's a saying in markets, the trend is your friend until the end. And right now, the trend in silver is clearly up. The question is, how long does this trend last? And how high does it go? Based on the fundamentals I've laid out, based on the supply constraints and the growing industrial demand, based on the investment flows that are just starting to materialize, I think this trend has a long way to run. I think we're in the early stages of a multi-year bull market in silver. But don't just take my word for it. Look at the data yourself. Look at the supply numbers. Look at the demand projections. Look at what's happening in the physical market. Look at the premiums on coins and bars. Look at the inventory levels at the COMEX. All of these data points are telling the same story. And here's the final thing I'll say. In markets, you make money by being early, by seeing what's coming before everyone else does, by positioning yourself ahead of the crowd. Silver is giving you that opportunity right now. The price is broken out to levels not seen in over 4 decades. But the move is just getting started. The fundamentals are stronger than they've ever been. The supply-demand dynamics are more favorable than they've been in generations. And the mainstream still hasn't caught on. That's your window. That's your opportunity. The question is, what are you going to do with it?